Hi, and welcome to another Titan Talks. My name is Zainab. I'm excited to bring to you a conversation on the evolution of alternative investments. Today, joining me, we have John Ulrich, President and CEO, along with Whitney Solcher, the Chief Investment Officer of Ulrich Investment Consultants, headquartered in San Antonio, managing $2 billion in total assets. Thank you both for joining me today. How are you doing? Would you like to share more about your firm?
Yeah, thank you. Actually, it's really a pleasure to be here. And our firm consults to roughly $3 billion in assets, give or take. Primarily, it's about half institutional and half high net worth and high net worth families. And in that particular niche in the business we're in with institutionals, we have a pretty big contingent of clients that are Native American tribes and their tribal entities. So we've enjoyed that space and look forward to continuing to grow.
Excellent, great. And I think from there we can jump into the first question. So what is an alternative investment? Why would someone invest in one?
So people generally think of a traditional portfolio allocation as a 60-40. So 60% equities, 40% bonds. You really look at the equities for growth in the portfolio and you look at bonds for income in the portfolio. And really alternatives are really an alternative to those asset classes. So diversifying away from some of those traditional public markets and accessing some of the private markets. So some of these alternatives can include things like private equity, private credit, private real estate, commodities, and other hard assets. Typically, the reason an investor would allocate to these assets is for diversification. Again, moving away from those traditional public markets and seeking higher return along with potentially lower volatility. We can talk a little bit about that later today, but shifting what you're trying to do is shift that risk return goal to a more optimal portfolio allocation.
Excellent. You mentioned some of the nuances of investing in alternatives. I was wondering, what are some of the challenges for individuals, that you see from, your experience in the field?
So in the past and some of the more traditional alternative assets do have some difficulties or some kind of prohibitive to some investors investing. So they may have very high minimums, particularly. So it could be $1 million, $5 million, 10 million and upwards. And so it's hard for a person to allocate to. Sometimes the fees can be very hard. The amount of due diligence you need to do behind alternative investments, there's just not that public access to information that you get if you're just simply looking up a mutual fund on Morningstar. So it's harder to get information and get comfortable with the investment. Some of the other issues is just the paperwork. So there's lengthy subscription agreements typically that are involved with alternative investments, lots of legal jargon. And then also from a reporting standpoint, you typically get a K-1 versus a 1099, which can also, be cost prohibitive to some people.
Excellent. And, maybe we can shift now that we have a broader understanding of alternative investments. When we look at the evolution, maybe you can talk about some of the nuances over time that you've both witnessed in your career.
Yeah, well, thanks for that question, because I think it's kind of interesting to kind of look back at the history of alternative investments. And although we think they're a fairly modern sort of approach, they're really not. Alternative investments have been around since, thousands of years. Investments in commodities predate most modern stock markets. And actually, if you think about some of the better alternative investment structures, think of the Transcontinental Railroad, which was built by industrialists who decided to invest in a project because the government didn't have enough money to finish it. First leveraged buyout was done by JP Morgan when they took over Carnegie Steel. So these types of investments where you're investing directly either in infrastructure, hard assets, as Whitney talked about, commodities, or infrastructure have been along for a long time. The difference is when the people that used to invest in those assets, you required huge amounts of wealth, and they were very limited. What we've seen in the evolution, particularly the last 15 or 20 years, has been taking those alternative investments and making them available in a wide range, mostly to institutional investors. So many college endowments, I think the Yale model is widely known for understanding the importance and diversification effects of alternative investments. But I think you really need to look at the wide variety of alternative investments that are out there, as Whitney was talking about, and really talk about and distinguish between really what types of alternative investments they are and which ones involve investments in hard assets or infrastructure, things of that nature, and which involve a lot of financial leverage. And so what we've seen is a movement, particularly lately in the past few years, really in the last 4 to 5, is a proliferation of products being developed by large Wall Street firms who have determined that a very attractive market is the ability to bring these alternative strategies down to the retail market. And I think there's many pitfalls about looking at those strategies because all alternatives aren't the same.
Excellent. I think that brings me to my last question. You honed into all alternatives aren't the same. So how do we measure success when it comes to alternative investments?
It's a great question because it's actually very, very confusing also to clients to understand how their alternatives are doing. And traditionally, there's 2 metrics that people look at. One is IRR, so internal rate of return, and the other is a multiple return on your investment. And neither one are exactly accurate. So for instance, an IRR, you could say, okay, you got a 20% IRR, but perhaps you only had a small amount of the capital called in that private investment that got that 20%. So overall, your commitment didn't make that big of a return, but they just returned capital to achieve faster. Otherwise, somebody could say, well, you got 2 times your money. But if that was over 15 years, that actually equates to about a 5% annualized return. So you really both kind of lie to you. You have to look at both together. And then now people are moving more towards a public market equivalent. So really having to kind of back into the math and think, if I had invested the same amount of money in the S&P 500 and compare it to this over this 10-year period, how did I do? And so that's really where the market is moving towards. The other thing is you really need to look at risk-adjusted returns. I mentioned volatility earlier, and that typically clients experience lower volatility in private investments, but that's really kind of a lie in itself as well, because they really only report on, let's say, a quarterly or monthly basis. So you're not seeing this day-to-day NAV swing back and forth. And so overall, it feels like less volatility, but in reality, if you had to sell a building overnight or a business overnight, you're going to experience a lot of volatility.
Absolutely. I think that was really helpful. Thank you for taking the time to answer those questions and the insight. I know we have a few more minutes. So is there any other insight or comments that you might have for individuals or advisors in the field?
Yeah, I think, when it comes to investing in alternative investments, we think it's a great asset class. We've really started to allocate more assets. But as I mentioned, I think really having a thorough understanding of what you're actually investing in. Just and a couple of caveats, a lot of the institutional products and track records that were created long ago aren't always a great indicator of what the returns are going to be going forward. So you really have to understand and do thorough due diligence on understanding exactly what you're investing in, and don't just buy the story.
Absolutely. Thank you both again for joining us for this week's Titan Talk. You might spark some conversation in the comments. So for those who might have a comment or two, please feel free to reach out to either John or Whitney over LinkedIn. Thank you both for joining us today. And we'd like to, invite everyone else to join us again next week for another session at Titan Talks.
Thank you.
Thanks. We appreciate your time.
Have a great week.
Likewise.